past few years in Santa Barbara have set a high bar for achievement by companies that started up locally, kept their headquarters here, and grew nationally and, in fact, globally to become public companies. We're so honored to have leaders from two such companies with us this evening. But it's not just IPOs that mark a huge milestone for a once tiny startup. Growing to scale where your company can be acquired and help another company grow and continue to innovate is also a challenging task and a remarkable accomplishment. We're joined tonight by a venture capitalist who has helped 9 companies grow to become acquired in his career. And this evening, we have the most knowledgeable and experienced set of experts to take you from startup to IPO and beyond. It's a great honor to introduce our keynote speaker this evening, a woman who has had a leading and successful role in nearly every step of building a growing company. Liz Beyer is the founder of Class 5 Group, where she advises the management teams of private companies on how, when, and why to go public. She was one of the chief architects of Google's IPO and has managed dozens more since then. Prior to Google and Class 5 Group, she was a top-ranked research analyst while at Credit Suisse First Boston and was an institutional technology investor for mutual fund company T. Rowe Price. Please welcome Liz Beyer.
Yes, I am here to talk about IPOs, of how to best characterize the current IPO market. And then I found this. That's actually where we appear to be right now. There have been this year, as you may or may not have read, very, very few IPOs. In fact, it's been 5 year to date. They've all been in the biotech sector. That compares to 27 year to date last year. And last year was really a pretty lousy year for these. There are 3 factors that are influencing the current IPO market and investors' current interest. The first one is volatility. The second one is an act passed a couple of years ago called the Jobs Act. And the third is, frankly, the performance of recent transactions, which has had a sort of negative impact on the current marketplace. Volatility in the marketplace definitely equals risk. Because when you wake up and you don't know what your basic portfolio is going to do, about the last thing you want to do is invest in a brand new, untested, recently public company. And IPOs are, by definition, the riskiest of public equities because they haven't been tried in the markets, and management is still learning how it all works. So truism number 2 is that IPOs are definitely more risky than proven companies. And therefore, when the VIX, which is a measure of marketplace volatility, is up, there are fewer IPOs. It's made the market really difficult to predict. And as soon as the VIX goes up, historically, the number of IPOs pretty much shuts down. The second thing I want to talk about is the Jobs Act. And the Jobs Act was a brilliantly named piece of legislation who's going to vote against something called the Jobs Act? And the intent, in part, was, or the spoken intent was, let's make it easier to take a company public. Let's remove some of the burden. You don't have to have 3 years of audited financials. You only need 2 years of audited financials. You don't have to publicly file your documents until you are ready to go. And the third piece was, there used to be a doctrine that said when you have 500 shareholders, and that includes your employees as option holders, you have to release your information, your financial information, publicly. And the thinking was that if you had 500 shareholders, you couldn't verbally tell them all how you were doing, but they deserved to understand what was going on with their investment. So you would file a document called a Form 10 that basically put the financials out there. Most companies, and I would include Google and Facebook in this list, used the fact that they were forced to publish their financials as a reason to go ahead and do an IPO. You didn't have to go public, but you did have to publish numbers, and that was the forcing function. The Jobs Act removed that stipulation. So what did it mean? 1, it opened the public markets for smaller, less proven companies. And we clearly saw this with the huge number of biotech and life sciences deals that have happened in 2014 and 2015. Again, nothing is really going on right now. The second thing it did is it created the unicorns. which are private. I'm sure everyone has probably heard of them, but unicorns are private companies with a valuation of more than $1 billion. And since the year 2000, I think 2002, there have been 39 venture-backed companies. Well, we'll get to this in a second. But there have been 39 venture-backed companies that have attained a valuation in the public markets of higher than $1 billion. And we'll see what happens here in just a second. So how did it create the unicorns? When you took away the 500 shareholder rules, it meant a lot of other individuals could still invest, a lot of other entities could invest privately. And particularly the mutual funds, because there was some confusion about, is a mutual fund an investor, or is the mutual fund a representative of a large number of investors? And some of that confusion went away. So you saw a ton more money piling into the private marketplace, which meant companies didn't have much of a reason to go public. And going public is a pain in the neck. And if you can raise all the money that you want privately, why go through the hassle? This worked incredibly well for private investors, because instead of having to share the opportunity on the most proven companies with the public markets, their most proven, their biggest, their most successful companies could stay private much longer, which is why we have Uber at $61 billion and Airbnb at the size it is. What's the purpose of doing an IPO? And in fact, an IPO is not for every company. Many shouldn't be forced to undergo that spotlight, or are better off as divisions of larger entities. It's certainly a pain in the neck, as you will hear, I suspect, later. It's a pain in the neck process to go through, and there are hurdles along the way. So why do it at all? Well, number one, to raise capital. And there's a slight difference, of course, as I just said, you can raise capital in the private markets, but that's concentrated capital. And that will bring in new people who want to help you direct how your business should be run. Some of you are probably sitting in the audience. So one is to raise capital, but two is to generate liquidity. Often, companies have made an implicit bargain with their employees that says, you come to work for me now, at some point I'm going to give you a liquid security, and that doesn't mean it's liquid on the third month of the fourth day of the third month of the fifth year when we do a particular buyback. It means every day you have the option to buy or sell stock, just in case you wanted to buy a house or buy a car, but it's to generate liquidity. It's to enhance credibility. Surely when you're playing in the big leagues, sometimes when you're selling product to major corporations, it sometimes helps them feel better about the product. Say, wait a minute, this is a public company. Clearly it has the financial wherewithal to be there. I'm willing to take a risk. And fourth, creating a public currency. And this is a big deal. When companies want to use stock to buy another company, how do you agree on what your stock is worth? I may say, each of the shares of my company are worth $20 a share, and you may think they're worth $10 a share. And unless we have an ongoing liquid market of third party, we don't know how we settle in the middle. So often companies will go public just to establish what is a valid price for the stock. A year ago, it would have been all about how fast can you grow. Today, people are more concerned about companies being able to continually fund themselves, since the spigot seems to be slowing down. What does it take right now? First of all, it takes size. Unless you're in the healthcare field, where you can be a much smaller company. But if you're in general tech or consumer, revenues need to be very close to $100 million to get investors to pay attention. Two, you need to be able to explain how you're going to be profitable, and probably within the next 18 months. A year ago, don't worry about profits, just grow as fast as you can. And so investors are quite fickle, which is why companies actually need to run the business for what is best for the business. But nonetheless, if you want to get public now, you better be able to show people how the business is going to be able to stand on its own 2 feet without having to constantly come back to the market from a fundraising perspective. You need a credible management team, and technically one that has been there for a while. Every so often, companies swap out the CFOs 20 minutes before the IPO, and that scares investors. And finally, who's management? And the single most important, from my days as an institutional investor at T. Rowe Price, the thing we cared about 60% of any IPO is, who are the people running this? Because every company is going to run into a hurdle or a wall somewhere along the way. Does this management team have what it takes to figure out how to solve the problem? So that's probably the most important thing. What it doesn't take, an overly complicated story. The more buzzwords and nuances you have to throw into explaining what you do and why there's a need for it, the less interesting it is. And the really good news for you guys is that I think being out of, frankly, Silicon Valley or the Route 128 area is going to be an advantage. In part, I think, because you probably wasn't the same pressure to price astronomically. Well, we're worth $4 billion, so you should join us. And two, I think perhaps there's a little less job hopping down here, and I think that's going to be a super helpful thing.
So I'm Ida Kane, I'm the CFO at Appfolio. Just in case anybody has any questions that I can't answer, one of my co-founders is here. He might be the tallest guy in the room, John Walker, so you can look for him afterwards as well. Just a little bit of background on Appfolio. We started the company in 2006, and as a private company, raised $62 million. We were not a unicorn in raising that money, which actually bode really well for us going through the process. And as much as private companies, I think, do have a lot of self-worth, and that's important, and that is definitely a quality that I think bodes well for an entrepreneur. I think being realistic about that is also really important, especially if down the line you expect to be a public company, especially in today's market. The last round that we raised as a private company was in 2013. We went public in June of 15 on NASDAQ. If you remember Liz's slide right before the VIX had that big hiccup in July, we went out right before that. So luck is definitely part of the equation. You have to be prepared and ready for the window if there is a window about to open or close, but thankfully we were ready. We raised gross $86 million, so relatively small raise. That was important to us from what we needed to get across the finish line. I'll talk a little bit more about that, but it's relatively small raise. We did it really fast. From our first confidential filing until we launched our IPO was 59 days. It's pretty unheard of. We were very early stage. Our last 12 months revenue behind our IPO was $60 million, so really small company for an IPO. And we knew we had a long way to go. Our mission is grand. Our business model is a solid one, but we're still early. So the liquidity for us was really getting a financial currency that would allow us to invest reasonably within our business to continue to grow. We also expected that along the line there would be some kind of correction in the market, and we wanted to have the currency to be able to take advantage of acquisitions to the extent that there were particular ones that were interesting to us that fit our business model. We had nice revenue growth. We didn't have a huge revenue number. As I mentioned, it was $60 million, kind of trailing 12 months going into the IPO, but our path to profitability was visible. And when we were out testing the waters, it was one of the things that a lot of investors were talking to us about. You don't show financial numbers there, so it was something that we kind of took away. But definitely in the roadshow, a lot of investors were like, wow, you guys are actually really close and your revenue growth is still phenomenal. And that spoke to the discipline with which the company had been built over the years. So spending time with investors so that they understand and that you can articulate and give them appropriate expectations around what the long-term viewpoint there was really important to us and important to them, and something that we spent a lot of time on going through the process. The co-founders spent a lot of time telling the story before we needed to write the S1. And that was really important. I remember stories from the bankers where there'd be a ton of people together writing the story, and the CEO would come in at one point and read it and rip it up and throw it out and start all over again. We started, and again, I would say, this short time frame, that was based on all of the work that was done up front, right? So we spent a lot of time with our lawyers, with a few really important advisors, not a room full of them, but some key people to help us tell a story of, why is our market as large as we believe it is? What are our differentiating, either, from a technology, from a people perspective, how we approach it, what's our competitive advantage, and why Appfolio compared to any other company. So really getting that story straight and not letting it be a distraction. We very much contained it within the organization so that it wasn't a distraction for everybody. It was a full-time job for a few of us, and not a huge number of us.
Our next speaker is Jim Adelman, Managing Director of Rincon Ventures. Jim is a co-founder and Managing Director of Rincon Ventures, a Santa Barbara-based early-stage investor in software and internet startups. Together with his partners, he has raised $100 billion and invested in over 30 companies, 9 of which have been acquired. Local investments include HG Data, Invoca, and Local Market Launch. Welcome, Jim.
We're one of the more tightly focused venture capital firms you'll meet. We invest almost exclusively in B2B, internet software-based recurring revenue businesses. We believe that expertise and focus is a big plus in an ever-increasingly crowded venture market. I moved here from the Bay Area, launched the fund because I saw an opportunity represented by Southern California. That remains our sort of major, our concentration. About 2/3 of the portfolio is in Southern California, and the other third ballpark is up in the Bay Area. Because we are a B2B internet software investor, Bay Area is just a beast. It's 50% of all public software companies are in the Bay Area. And so there's just a very healthy ecosystem. And that gives us good perspective on being able to sort of evaluate the things we see down here and not have a limited sort of scope. We are an early stage investor, most typically post-seed entry. These days, the typical first series financing for a startup is a convertible note that's sort of easier to raise because you don't need a lead and you can get it in dribs and drabs and you can sort of kick the can down the road on what the actual valuation is. When companies use that money to build their initial core team, build their initial product, hopefully get some customers, and then they enter sort of a new period of investment in hiring salespeople and actually doing some marketing and trying to create scalable customer acquisition. So that's really where we enter, and that's sort of what we're good at. Still typically called seed, so as in SEED, not the letter C. So we still get to think of ourselves as cool and call ourselves seed investors. My partner and I, there's just two of us. We run a concentrated portfolio. A lot of seed investors are high volume, low involvement investors. We like to think of ourselves as kind of the opposite. We typically lead or co-lead. We typically take board seats, and we are a life cycle investor. So for every dollar we invest, we typically reserve about another dollar to put into those companies subsequently. How we're doing so far, we've been at it 10 years. We're on our third fund. This one's about a $40 million fund. The chart up there is we've invested in 32 B2B internet software companies over our history. So far, 8 of them have sold to companies like Singtel, Shabzilla, Criteo, Google, Apple, Broadsoft. I stole this from Mark Schuster's presentation, so credit to Upfront. Essentially, you've seen over the last 5 years a boom at the seed stage on deal count basis. So if you add up just the last 4 years, it's over 16,000 seed rounds. And that's grown way outpacing early stage and later stage ABCD. And then on a dollar basis, which is exactly what Liz talked about, the late stage has seen a dramatic increase in those dollars. And something like 75% of those billion-dollar-plus valuations involve the participation of a non-VC, a hedge fund, a mutual fund, a corporate sovereign wealth fund. And so really fundamentally that phenomenon would not be happening were not for the entry of those participants. And combining those two things, 2015, this is venture capital dollars invested into U.S. companies. And and it's the biggest since the bubble, and we know how the bubble ended. And interestingly, so deal count basis 2015 was not that different. And so it's all about the average deal size going way up, and sort of this concept of averages being misleading because it's extremely concentrated, right? You look at companies like Uber and Airbnb and Lyft that were mentioned, and billions of dollars of this is just 10 companies. And despite the fact that 2015 was up a lot as a whole, you can see, it fell through the floor in Q4. So it's tough out there. It's kind of ugly. So the question is what to do. First, adjust expectations. My advice number one is don't think you failed or that it's inconceivable to do a flat round or a down round. Being able to stay in business equals success these days for venture-backed businesses. Next, be thrifty, right? Thrift is the new black. I thought it was funny that it was guys like Bill Gurley and Mark Andreessen who have some companies with some of the largest burn rates on the planet saying that, now's the time to tighten the belt and focus on gross margins. Next is rally insider support. If you have existing investors, if you can choose your investors, choose ones that have a propensity and a demonstrated track record of investing in follow-on, even if there isn't a new outside lead that shows up. So do your best to rally support from your insiders. They're the ones who have a vested interest in your continued existence. Next, get creative. There is a record number of corporate VCs active right now, and there's a record number of corporate VC capital deployment. They tend to have, ulterior motives other than just the profit motive. So if your business is of strategic value to them, they might be more likely to write a check even though the market is tough. And finally, be awesome. Great companies that are growing like crazy are still getting funded. The bar just goes up.
My name's Allie Bauerlein. I'm the CFO and one of the founders of Imogen. And for those of you who are not familiar with what Imogen is, we're a medical device manufacturer. We make a portable oxygen concentrator for people who have respiratory diseases. And the company was founded here in Santa Barbara back in 2001. So we were around for quite a few years before we became an overnight success with an IPO in 2014. So it was a long road to get there. And looking at our story and kind of what made it the right decision for us to consider an IPO is we were looking at what value we could provide and how we could be different in terms of our story. And there were kind of a lot of things happening in our market at the time that we thought would really bode well in the public markets. And the first is that our industry was really going through a significant change. And reimbursement in our industry in the middle of 2013, half of our Medicare markets got a 40% cut to rates. And most people hearing that go, oh, that's really bad. 40% cut to rates. This can't be good for your business. But what it did was it was an opportunity because the old model that was in place in the industry had to change, and it had to change to technology like ours. And so that opportunity was something that we didn't want to pass by. But getting access to those markets and really continuing to grow the business as quickly as we wanted to took capital. And we had already raised venture capital funding. We got our first venture capital funding in 2003. So VCs had been in about 10 years at that point. And so they were saying, at what point are we going to see some liquidity? We're reaching some of our 10-year limits on our funds, and we have to see where this is going. But we also see this long-term opportunity of what could happen in this market. So, looking at the opportunity, deciding to go public, obviously the natural thing was, why didn't you consider being acquired? And I think a lot of it had to do with the management team. The management team saw this huge opportunity, and the thought of getting bought by another company and then maybe or maybe not being part of the team that would take this to the next level, that wasn't really something we were interested in. We really wanted to be the people taking this company to the next level. Obviously, we considered private equity as a source because they're typically not going to exchange out the management team. But our VCs, on the other hand, were saying, well, the valuations aren't good enough. And so, you talk to private equity firms, they're looking for a deal, and they're also not looking to put a lot of cash into it. They want a business where they can get cash out of it, not something that they're going to have to put a bunch of cash in order to see a return over time. So for us, it seemed natural to consider an IPO. When we ended up going out, it ended up being February of 2014. There was a lot of competition for IPOs. There was, I think, 7 healthcare IPOs pricing the same week that we went out. So it was a very busy time, and it was hard to get attention. And we broke issue. The first day we traded down, and that was something where we went, we've broken a cardinal rule. Now, obviously, we've recovered nicely since then, but kind of walking through that process, it was important to understand what's going on all around you, not just what's going on with your business. And that's what the bankers are there for. So execution is absolutely important, and you need to get that credibility in the markets because otherwise your stock will have increased volatility if people don't feel like they can rely on what you're saying. And then that's us at the NASDAQ. So that's it. Thank you.